This PowerPoint demonstrates the procedure for using a worksheet to prepare the statement of cash flows from changes in the balance sheet. This process is important because it demonstrates how a firm would prepare a statement of cash flows using the indirect method. It's also a process that we will come back to later in the course when we are preparing our forecasted financial statements, because we will use a similar procedure to prepare our forecasted statement of cash flows. For this example, we will use data for GTI Inc., which comes from problem 3.25 on page 220 of your text. In that problem, we were provided with balance sheets for GTI for the end of year 7 and the end of year 8. We're also provided with an income statement for GTI for year 8. And we're provided with some supplemental information. In particular, that depreciation expense in year 8 was $641,000. That GTI did not sell any fixed assets in year 8. That other assets on the balance sheet consist of patents. That patent amortization was $25,000 in year 8. That GTI did not sell any patents in year 8. And that changes in deferred income taxes should be classified as operating activities. Our first step is to calculate the change during year 8 for each account on the balance sheet, including every asset account, every liability account, and every shareholder's equity account. These changes are calculated and shown in the last column on this table. The next step is to transfer all of the changes we just calculated into the first column of the balance sheet of the worksheet, the column titled Balance Sheet Changes. Now we must transfer every single change that we calculated off the balance sheet onto this worksheet, or our statement of cash flows will not balance with the changes in the balance sheet. Also, very important, please note that on the worksheet, increases in the asset accounts are shown as negatives, while decreases in asset accounts are shown as positives. While increases in the liabilities and shareholders' equity accounts are shown as positives, while decreases in liabilities and shareholders' equity accounts are shown as minuses. Again, it's very important that the signs be shown correctly on the worksheet. The reason for this difference is because an increase in an asset account results in a decrease in cash, while an increase in a liability account results in an increase in cash. You may find it helpful to refer back to the DIAL or DIAL matrix, which is shown in the class notes for this week, to recall how these changes work. The next step is to begin assigning all of the changes that we've entered in the balance sheet changes column to one or more of the categories: operations, investing, and financing, which of course correspond to the 3 sections of the statement of cash flows. So the first step is to assign the changes in the working capital accounts to operations. So all the changes in accounts receivables, inventories, prepayments, accounts payable, and other current liabilities are assigned to operations. And in this case, because we were told to in the information provided in the problem, we also assigned the change in deferred income taxes to operations as well. The next step is to allocate the change in the property, plant, and equipment and other asset accounts to operations and investing. For PPE, note that there are 2 things that drive the change in the balance sheet account. First is depreciation. We were told depreciation was $641,000 in the year. And the other event which changes the plant, property, and equipment account is the purchase of additional property, plant, and equipment. We were told none was sold this year, so only the purchase needs to be factored in. So we entered the depreciation amount, $641,000, in the operations column. You should recall that in the statement of cash flows, depreciation, because it's a non-cash expense, is an add back to cash flow from operations, or an add back to net income to get cash flow from operations. So we put $641,000 in the operations column. And the difference to get to our total balance sheet change of $792,000 is $1,433,000, which we put in the investing column. So our firm must have purchased $1,433,000 of additional PPE during the year. And we show that as an investing activity. It's a use of cash to acquire the additional PPE. The other asset line, which we're told consists all of patents, is spread using a similar process. Amortization of patents during the year was $25,000. We put that in operations. Again, that's an add back to net income to get to cash flow from operations. And the difference to balance the line is a minus $391,000, which we put in the investing column, which indicates that during the year, GTI purchased $391,000 of additional patents. The next step is to assign all the changes in the debt and stock accounts to financing. In this case, all of these accounts showed an increase, which indicates that GTI issued additional notes, long-term debt, preferred stock, and common stock to generate cash to use to finance its operations investing activities. So the increase in notes of $220,000 indicates the addition of a net additional amount of notes payable of $221,000, and we allocate this to financing. Long-term debt, an increase of $2,339,000, again, a financing activity. And the issuance of additional $289,000 of preferred stock. The issuance of $2,000 of common stock and the associated additional paid-in capital that's associated with that issuance are also both assigned to financing. Our last allocation is we have to allocate the total change in retained earnings to operations and to financing. You should recall that retained earnings is affected by, one, the receipt of net income, which increases. If their net income is positive, that's an increase in retained earnings. And the other thing that affects retained earnings is the payment of dividends to shareholders. Now, in this case, on our income statement, we know that net income for the year was $417,000. So the difference between the $417,000 and the total change in net earnings shown on the balance sheet is a minus 12, which suggests that the company paid $12,000 in dividends to shareholders during the year. So the $417,000 net income is classified as operations, and the $12,000 payment of dividends to shareholders is classified as financing. All payments to shareholders are always classified as financing. The last thing we do on our worksheet is total up the columns, total up the items in the columns for operations, investing, and financing, which gets us to our total change in cash number for each of these three activities. And these are the same numbers that will appear on our statement of cash flows. So finally, the last step is simply to transfer all of the numbers from the three columns of our worksheet to our statement of cash flows. Again, we have to make sure we transfer every number off the worksheet to our statement of cash flows, or our numbers won't be consistent with the changes in the balance sheet. So within operations, we show net income or loss. That was the amount of retained earnings that was transferred or allocated to operations. Then the add backs for depreciation and amortization. Then the changes in all of the working capital accounts, which results in a total cash flow from operations of minus $976,000. Under investing, we show the amounts identified for the acquisition of PPE and the amount identified for the acquisition of patents, results in a total cash flow from investing of minus $824,000, minus $1,824,000, excuse me. And under financing, we show the increase in cash attributable to the increase in notes payable, the increase in long-term debt, the issuance of preferred stock, the issuance of common stock, and the reduction due to the payment of dividends, for a total change in cash attributable to financing of $2,824,000. The net amount of the total change from these three activities is an increase in cash of $45,000, which is consistent with the number we calculated by comparing the beginning balance sheet to the ending balance sheet, which means that our statement of cash flows is consistent with and balances with the balance sheet. You have a homework problem this week where you're asked to do this similar process for another company. You may find it useful to refer back to this PowerPoint as you are working on your homework.